Hey guys, and welcome to another episode of Stock Talk. Typically, we bring you a specific stock or sector we'd like to cover for you, explore that company or the industry, and get your thoughts. But so much has been happening in the market lately. So we want to know, how is your portfolio doing? Have you been day trading or do you follow a buy and hold strategy? Hopefully you didn't go all cash at the height of the pandemic. There is no question the market has had a lot of drama since the pandemic began. Today, we'll be exploring the markets at large key indicators, the Fed, and where we think it's all headed. Obviously no guarantees, but stay tuned to find out and learn more about it. As always, if you've been enjoying our content and have been learning a lot, give us a like and subscribe to our channel. Before the pandemic, the market had been facing one of the strongest rallies in stock market history since the 2008 recession. The market had kept climbing up, and everyone was just as excited as they were wary. Was it a bubble? Was it overdue for massive correction? Undoubtedly, over the 10-plus year rally, the market had had its pullbacks, but no one really knew if that was just really the end of it all or just a tease. Turned out they were teases, and the market kept climbing each time. From dipping below 1,000 points to 683 in March of 2009 to breaching 3,300 in February of 2021, right before the pandemic, the S&P 500 basically made the case for passive investment management. Throw your money into an ETF, let it ride, and let it grow. You could have basically forgotten about your portfolio and you would have outperformed many active managers trying to beat the market. It was a tough time to be an active manager. You had to constantly sell your clients the gospel of downside protection in exchange for lower returns than the market at large. And if you were an alternative asset manager, you saw an even bigger challenge: increased correlations to the asset classes you were trying to not just beat, but diversify against. Active managers' vindication finally came in February of 2021, with the coronavirus absolutely tanking the market, plunging from 3,300 levels and nosediving straight down to the 2,300s. Now, if ever there was a time to buy, then that was it. And you had a good 7 months to do so before all pandemic losses were recovered, because by the time August came around, we were back in the 3,300s. Unemployment ran high, over 14%, but benefits were extended, stimulus checks were issued, meme stock investors were born, the Fed pumped money into the economy like never before, and we even saw one of the most rapid vaccination campaigns in world history. And where did this leave us? Well, fast forward to today, where the S&P finds itself at 4,369.55 as of market close Friday, and let me tell you, I am blown away. You could actually say that the pandemic was the one so-called correction the market needed before continuing on its wild rally. But tell me, I'm curious, how many of you out there got in during the pandemic? When did you get in? What did you invest in and how was your return? It's crazy to think that even if you got in after full recovery of the losses, you still made money. When taking a look at the health of the overall market, honestly, there are so many metrics to consider, and you'll always find someone who will tell you, when looking at XYZ metric over the past X number of years, you'll see the market historically skyrockets or tanks after it reached this or that level. Look, many of those are valid points, but we caution you from looking at them in isolation. It's better to get as holistic a picture as possible, and that comes from unemployment, inflation, GDP, the infamous yield curve, consumer spending, housing starts, oil, etc. The list goes on, but typically those are some of the data points that wealth managers, economists, and the Fed use in assessing the health of our economy. So let's start with the hottest metric right now, unemployment. At the height of the pandemic, unemployment was as high as 14.7%, well above the 10.6% rate during the aftermath of the 2008 recession. But that was all artificial, all due to the lockdowns. Fast forward to where we are now at 5.9% as of the most recent quarter. Now, this is still above what economists call NRU, or natural rate of unemployment, which is accepted to be around 4%, but we're getting there. In fact, the most recent job reports released just this month show that US payrolls have jumped the most in the past 10 months, with the strongest gains in leisure and hospitality and small business in general. And not only that, we've also seen relatively healthy wage inflation averaging 3.4% across the board, and an impressive 4.2% for the bottom quarter of income earners. And that's the perfect segue into another hot topic: inflation. Even before the pandemic, inflation was sluggish. The stock market rally outpaced it like no other, and throughout most of the pandemic, that remained the case. The magic number is 2%. That number is both art and science. There is no single equation that helps the Fed arrive at that number, but it's certainly not a random guess, either. Even though there may be some of you who don't really trust the Fed and think this is all a crazy game. What is known throughout history is that continued periods of under 2% inflation put the economy at risk of deflation, similar to what Japan has been dealing with for over a decade now. We also know, if you recall from one of our prior episodes, that once inflation exceeds 4%, the economy runs the risk of overheating. Investors panic at the thought that the Fed may end its cash injections, and they create this sort of self-fulfilling prophecy feedback loop in the market, selling off stocks in what becomes a race to the bottom. And that's actually exactly why inflation is such a hot topic right now. Guess what the current inflation rate is? Well, for the 1-year period ending in May, inflation has been a whopping 4.99%. This has some investors pretty worried. Now, the Fed has insisted time and time again that such inflation is transitory, just due to reopening the economy, and that any talks of tapering or pulling back asset purchases are still far off into the future. As it stands, the Fed continues to buy treasuries back from the open market at the awe-striking rate of $80 billion per month, and even continues to assume depressed inflation over the long term, now loosely targeting 2% inflation on average, as opposed to the constant and sustained. Again, they are sticking to their guns on this one. Inflation is transitory. But not everyone agrees or even believes the Fed. Even some experts balk at the idea that inflation could ever be considered transitory. After all, when in history has inflation ever been transitory? So we ask you, what do you think? Leave us your thoughts in the comments section below. The other metric we can't forget about is GDP. Things on this front have been very good this year. The Fed has been expecting GDP growth at or over 6% for 2021, and we already reached 6.4% at the end of the first quarter. And don't forget the infamous yield curve. Thought we forgot about it? We almost did. It's almost all but dropped from the headlines. Pre-pandemic, all we could do is stoke the fears of an ever-flattening, if not even inverting, yield curve, and now, little to no mention. The only reason it was ever a concern was because, historically speaking, an inverted yield curve preceded a recession, but like we mentioned earlier, it still wasn't the only sign of an impending recession, and neither did it always result in a recession. As it stands now, we have a healthy distribution of yields across the benchmark maturities. As of Friday, the 2-year Treasury clocks in at 0.23, the 5-year at 0.79, the 10-year at 1.37, and the 30-year at 1.99. And in other news, consumer spending has been reliably up since vaccinations became more widely available this year. Personal consumption expenditures, as they are called, are up 3.9% for the month as of May, a huge change from the 1.4% back in January. PCE is important because consumer spending accounts for 70% of GDP and contributes to inflation. But now it's time for a quiz. There's been a debate over PCE as well as in regards to the infamous stimmies. In a Bloomberg survey back in February, 34% of respondents indicated they would save their third stimulus check, while an additional 20% would pay down credit card debt and student loans. While that's good for personal finance, it's not always good for the economy. This is similar to a tax cut. Sometimes it works, but if too many people save it, then it doesn't work. This is known in academic circles as Ricardian equivalence holding or remaining true. It was named after David Ricardo, an economist in the 1890s. He theorized that people anticipate higher taxes in the future to make up for the cut or the stimulus, so they never actually end up spending it to stimulate the economy. So let's put it to you now. In the comments below, what did you do with all your stimmies? How about a slightly different but related question? How many of you plan to buy a home? Housing starts have been up all year and the real estate market is booming, but yet there is still not enough supply to meet demand. How do you feel about filling up your gas tank now? At the height of the pandemic, we saw prices bottom out around $50 to $60 a barrel of oil. Now, some experts expect we may soon breach $75 or even $80. So sorry to those of you out in states like California. Now, like I said, these may be some of the main indicators of economic health, but they are not the only ones. They're the ones used by wealth managers, economists, and even the Fed to get a sense of what's going on. And there will always be a doomsday metric here and there that rises to the headlines. The point is that when you're getting a sense for yourself on how to plan ahead, how to invest your portfolio, a broad and holistic approach like the one we took today is your best bet in remaining objective. We're curious to hear your thoughts. Let us know what you think. And as always, if you enjoyed today's episode, don't forget to click like and subscribe to our channel. And I'll see you guys in the next episode.